Hello and welcome to our video on when student loans are due. If you're like most college students, you probably have some form of student loans to help pay for your education. But when are those loans actually due? Let's take a closer look. First, it's important to note that there are several types of student loans, and the due dates can vary depending on the type of loan you have. Generally speaking, there are two main types of student loans: federal loans and private loans. Let's start with federal loans. Federal student loans are loans that are funded by the U.S. Department of Education. These loans are designed to help students and their families pay for higher education expenses, including tuition, fees, and living expenses. There are several types of federal student loans, including direct subsidized loans, direct unsubsidized loans, and direct plus loans. Direct subsidized loans are available to undergraduate students who demonstrate financial need. The government pays the interest on these loans while the student is in school, and during the 6-month grace period after graduation or leaving school. Direct unsubsidized loans are available to both undergraduate and graduate students. These loans do not require the student to demonstrate financial need, but they do accrue interest while the student is in school and during the grace period. Direct plus loans are available to graduate students and parents of dependent undergraduate students. These loans do require a credit check, and the interest rate may be higher than other types of federal loans. The interest rates on federal student loans are set by Congress and may vary depending on the type of loan and the year in which the loan is disbursed. It's important to note that the interest rates on federal student loans are typically lower than the rates on private student loans. As I mentioned earlier, federal student loans typically have a 6-month grace period after graduation or leaving school before the student is required to start making payments. During this time, the government pays the interest on direct subsidized loans, but not on direct unsubsidized loans. Once the grace period is over, students are required to make monthly payments on their loans. The amount of the payment will depend on the type of loan, the interest rate, and the length of the repayment term. Federal student loans also offer a variety of repayment options, including standard repayment, graduated repayment, and income-driven repayment. Each of these options has its own advantages and disadvantages, and it's important to research each option carefully to determine which one is right for you. In addition, federal student loans offer several benefits, including loan forgiveness programs, deferment and forbearance options, and loan consolidation. Again, it's important to research these options carefully to determine which ones may be right for you. Overall, federal student loans can be a great way to finance your higher education, but it's important to understand the terms and repayment options for each type of loan. Be sure to read your loan agreement carefully, and don't hesitate to contact your loan servicer if you have any questions or concerns. If you have a federal student loan, you will typically have a 6-month grace period after you graduate, leave school, or drop below half-time enrollment before you have to start making payments. This grace period is designed to give you some time to find a job and get settled before you have to start repaying your loans. So, if you graduate in May, for example, your first payment would typically be due in November. However, it's important to note that not all federal loans have the same grace period, so you should check with your loan servicer to find out the specific due dates for your loans. Now, let's talk about private student loans. Private student loans are loans that are issued by private lenders, such as banks or credit unions, rather than the government. These loans are often used to help students cover the cost of tuition, fees, and other education-related expenses that may not be fully covered by federal student loans or other financial aid. There are a few key differences between private student loans and federal student loans that are important to understand. First and foremost, private student loans typically have higher interest rates than federal loans. This is because private lenders are taking on more risk by lending money to students who may not have established credit histories or a steady source of income. Another difference between private and federal student loans is the application process. While federal loans are issued by the government and have a standardized application process, private loans are issued by individual lenders, each of which may have its own application requirements and eligibility criteria. Private lenders will typically evaluate your credit history, income, and other factors to determine whether you qualify for a loan and what interest rate you will be offered. One advantage of private student loans is that they may allow you to borrow more money than you would be able to with federal loans. However, it's important to remember that the more you borrow, the more you will have to pay back with interest. Before taking out a private student loan, it's important to carefully consider how much you will need to borrow and whether you will be able to repay the loan after you graduate. Private student loans may also offer different repayment options than federal loans. Some lenders may allow you to make interest-only payments while you are in school, while others may require you to start making payments immediately. It's important to read your loan agreement carefully and understand the terms of your specific loan. Like federal student loans, private student loans may also have a grace period after you graduate or leave school before you have to start making payments. However, the length of this grace period can vary depending on the terms of your loan agreement. Finally, it's important to understand that missing payments on your private student loans can have serious consequences, including late fees, damage to your credit score, and even default. If you are struggling to make your payments, it's important to contact your lender as soon as possible to explore your options for deferment or forbearance. In summary, private student loans can be a helpful tool for covering the cost of education, but they come with higher interest rates and may have different repayment options and eligibility criteria than federal loans. Before taking out a private student loan, it's important to carefully consider your options and read your loan agreement carefully to understand the terms and due dates for your specific loan. Some private loans may require you to start making payments while you're still in school, while others may give you a grace period similar to federal loans. It's important to read your loan agreement carefully and understand the terms and due dates for your specific loan. In addition to the due date for your loans, it's also important to understand the consequences of missing a payment. If you miss a payment, you may be charged late fees, and your credit score could be negatively impacted. If you continue to miss payments, your loans could go into default, which can have serious consequences, including wage garnishment, tax refund offset, and even legal action. Thanks for watching. If you have any questions or comments, please leave them down below. And if you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more helpful videos on student loans and other financial topics.